Welcome, everyone. Thank you for joining. I'm excited because in this episode, together we get to look at a train wreck and the rubble and debris and the damage that's done after the fact. And that train wreck is the story fund. We're going to be looking at technology companies and what's been happening to them over the past month. If you're not aware, technology companies, especially SaaS companies, have been going through a very difficult time over the past couple of weeks. So we'll look at that together. The first thing I want to do, though, is just kind of back up and give you an idea of what I do when I check the markets on a daily routine. Here's a little bit of how I look at it. I first check CNBC, and I just look at the major indices and see how they're doing. We have the Dow Jones down 0.6%. We have the S&P 500 down, it's down 1.3%, so it's down a bit. And then we have the NASDAQ down 2.46%. And lots of news about the Omicron virus. I don't think that this sell-off really has much to do with this, in my opinion. I think that there's other reasons, mostly the Fed and tapering, but we have that in the news as well. So that plays a role as well. Now, of course, after checking the major indices, the S&P 500 and the Dow Jones and the QQQ, I then check and see how much Alibaba is down today. It's down 8.3%, for example, today, which is just a normal day. So we can check that off the list. Alibaba's down, nothing's different. Then we have Netflix. Netflix is down a little bit today. Netflix is down 2.5%. This is nothing alarming. Netflix likes to trade around. I've owned this stock for a while. I know that it's very volatile. But we have Crowdstrike. Crowdstrike is down 8%. That's not really a normal day for Crowdstrike. That's a pretty bad day. Then we have Snowflake. Snowflake is down 5%. Now, all these other stocks are starting to act like Alibaba. Not every stock usually goes down every single day. That used to be unique to Baba, but that's happening across the board now. Then we have Docusign. This one requires a double take. It's down 39.99%. 40% drop in one day. Now, we have a company that is an e-signature company that's worth, $27 billion now? The market cap has dropped substantially. Shopify's down 5%. Fantastic company, probably a little overpriced. 5% drop doesn't really surprise me, but it's a pretty big drop nonetheless. We have Microsoft. This is probably one of the best companies in the world, maybe the top three. It's down 2.5%, 2.7% right now. Then we have Salesforce. This is one of my favorite companies. It's down 3% just today. In the past 5 days, it's down 12%. Salesforce is dropping quickly. Adobe. This is down 8.5% today. Adobe's one of the best SaaS companies in the market. Look at their fundamentals. Look at their revenue, their earnings, their margins, their growth prospects. This is one of the best companies in the market right now. It's down 8.5% today. We can look at Atlassian, another company that I've made significant gains with, and it's down 6.6%, now down 7.3%. It just updated, so it dropped a little bit more. Atlassian's selling off as well. Now, you might notice a pattern there, some consistencies. The pattern is that across the board, tech companies are selling off. Left, right, and center. It doesn't matter which name you're picking, really what their valuation is, how good the company is, their fundamentals or future prospects. It's likely that if you own a tech company right now, it's down over the past week, and probably by a lot, unless it's one of the big tech names. If we look at my portfolio, for instance, if I filter by the 1 day, this is what the 1 day looks like. Every single company, every single holding is in the red. I mean, they're really in the red. The ones that are the most high-flying multiples, the most unknown, those are in the red the most. Overall, my portfolio's down $4,200 just today, just this morning. In the past week, it's down $8,500. My gains overall have been cut down by half in 1 week. That's how quickly things can change. Now, if I benchmark my portfolio, the story fund in blue, against the S&P 500, you can clearly see that for the past couple of months, I was above the S&P 500. And then over the past 2 weeks, it's pretty much taken a nosedive. Between Alibaba and tech companies, everything is down across the board. And right now, my returns since the start are almost 12%. They're 11.87% versus the S&P 500, which currently is 19.8%. And this has happened rapidly. Now, anytime my portfolio dips below the S&P 500, a couple things happen. I can expect a few things to happen. First of all, the critics that were silent while I was beating the S&P 500 all of a sudden surface in the comments, and they come up and say, this is why you shouldn't try to outperform the market. Nobody can beat the market. It's impossible. And, Joseph was never going to beat the market, X, Y, and Z. All of a sudden, the criticisms start to surface. For the past couple of months, when I'm outperforming the S&P 500, it's crickets from them. They're silent. You don't hear from them. And then as soon as I dip below, they'll start their criticism. So you're going to see that in the comments. It's happened every single time. When I was outperforming right here, no one was criticizing. As soon as I dipped below, then the criticism started. As soon as the portfolio went back above the S&P 500, the critics were silent, and so on and so forth. That happens every single time. The truth is that most investors are very short-term oriented. They're very short-term focused. Whether they like to admit it or not, they focus on the short term. Because the portfolio dips down for 1 week or 2 weeks, or even if it's down for a couple months, they'll say that that's defeat. That's losing. In reality, when companies dip down like this, especially world-class companies, and you're able to accumulate more shares at really low prices, that increases your future expected returns. Now, I have no problem with index investing. In fact, I would encourage everyone to have at least 50, 80% of your portfolios in major indices. I think that's a smart thing. Even in my other portfolio, the passive income account, I have a good chunk of it in major indices. So you capture all the market and all the gains no matter what is successful. But the goal of the story fund is different. The goal of the story fund was to outperform the S&P 500 by the end of 2025. That is the timeline that I set. I'm aware that I can't control short-term performance. I have no clue what this portfolio is going to trade at over the next month, the next week, and so on. I do believe over the next couple of years, with enough timeline, that certain companies will outperform other types of companies. Now, to give a little bit more insight in how I plan on outperforming the S&P 500, it's not just stock picking. I don't plan on just picking stocks. What I'm doing to try to give myself an edge of outperforming the S&P 500 is basically investing in technology and specifically software companies. Companies that have certain business models, where they have licensed business models, subscription business models, or usage-based billing. I think that those type of companies have economics that give them a huge advantage over most companies. So if you look at a story fund, it is a collection of high-quality software companies. From Google to Netflix to Amazon to Alibaba to Microsoft and Salesforce. These are software companies. That's the thing that they have in common. My top holding, which has been underperforming, and overall I'm in the red on, is IGV. This is the iShares Expanded Tech Software ETF. This invests in a variety of software companies that are the best ones in the United States. If we look at the holdings of IGV, it has a lot of these major software companies. The biggest holding and the only big tech one is Microsoft. That is a software company. It's in IGV. But then we have Adobe, Salesforce, Intuit, Oracle, ServiceNow, Autodesk, Synopsys, Palo Alto Networks, Cadence Design Systems, Workday, Snap, Docusign, Activision, Cloudflare, Fortnite, Crowdstrike, Zoom, so on and so forth. It is an ETF of software companies within the United States. IGV is a little bit of my anchor. It's the index that I think will outperform the S&P 500 over the next 5 years, at least until 2025. And the reason why is because, again, I think that these companies, they have characteristics that other companies don't have. Now, if we look at the actual performance of IGV, you notice that year to date, it's up 11%. The S&P 500 is up what, like 25% year to date? The S&P 500 has steadily been beating IGV this year. And if we look at the performance in more detail, we can see that since the beginning of the year, IGV was on a pretty good run, at least keeping up with the S&P 500. It was barely above it at 28.6% returns. Then over the past month, it went from 28% returns to 11.5% returns. So a lot of the returns for the entire year just got demolished in this past 30 days. So let me be straightforward with you here. Completely honest, if IGV, if tech software as an index doesn't outperform the S&P 500 from now till the end of 2025, then my portfolio, the story fund, is likely not going to outperform the S&P 500. That is the brutal, honest truth. My portfolio is a portfolio of software companies. Software companies right now are being crushed. There's nothing I can do about it. Just across the board, no matter which names you're picking, they are being crushed. If this continues to happen and software is never able to catch back up and people just go away from this sector completely for years, then I'll probably underperform. There's nothing I can do about that. These are the type of companies that I think will outperform though. And I really don't believe that over the long term, and I know it's difficult to see that now, but over the long term, from now until 2025, I don't think that this is going to stay like this. The markets can move incredibly fast. These companies can move up 11% in 1 week, 9% in a week, 10% in a month. Things change rapidly. So even though the portfolio is in the gutter right now, this can turn around incredibly fast. Software companies, I think, are the most dominant, most versatile, most rapidly growing companies in the market. Most of them carry no debt. They have no marginal cost of replication. They have incredibly necessary business products that work in every single environment. Come rain or shine, bad economy or good economy, these companies are going to do just fine. So the valuation concerns that are happening right now are really not a huge concern for me. I know this is difficult to believe, but I'm really not that troubled by this. So now let me go over what I plan on doing in this situation with this type of sell-off. It can be concerning. I mean, if you invested in a software company, you pick any of them and it's down this much over the past couple of weeks, you can start second guessing your strategy and think, man, I picked a bad company. I'm a bad stock picker because I invested in this software company and it's down this much over the past couple of weeks. That's really not the case. This is not company specific. It has nothing to do with the fundamentals. The entire category of company is being sold off right now. So what I plan on doing is with IGV down 6% overall, I'm literally in the red in software as a category right now with this index. I plan on averaging down. That's the most basic strategy that you can do in these situations. Here's the way that I think about this. Right now, IGV is down around 13% from its all-time highs. So around 10%, you want to do like one little buy because I think that's a good point if it drops 10% from its all-time highs. So that's what I did. This morning, when it hit 10% down from its all-time highs, I did a buy of $500. Now, that's not all my money. That's not the big buy that I want to do, buying the dip. But I think when it drops 10% from its all-time highs, you can start doing really little buys at that point. You don't want to rush in with all your money and your life savings and buy a 10% dip. It's not a big enough dip to justify it. And in my opinion, I think there's a very good likelihood that IGV could drop a lot more. It could come down 20%. I think that would be very reasonable. If it comes down 20%, I will up it from $500 to a $2,000 buy. Now let's just say that it drops 25% or 30% or 40% or 50%. It can drop 50%. I could see software selling down 50%. That's fine. If that's the case, if people really want to sell these companies at that price, if they want to sell companies to me like Microsoft and Adobe and Salesforce and Intuit at 50% the current price, I will buy it with every penny that I have. If this sells off aggressively, I mean, if we really get a 30% plus sell-off, I will be scrapping up every single penny that I have to buy these companies. I'm not buying junk here. These are not junk companies. These aren't garbage companies that make no money and they have, no revenues and they have no real products. Companies like Intuit and Salesforce and ServiceNow have massive revenues, have massive amounts of free cash flow. These are incredibly resilient, sticky companies with wide moats, very good balance sheets, and they have incredibly good prospects. So we'll see what happens. Maybe the market doesn't like software companies and information technology companies anymore. Maybe big firms just sell out of these companies across the board and they don't want anything to do with them. I think that's highly unlikely. In my opinion, information tech and software is virtually indispensable. It is part of the world. It runs the world. These companies will grow bigger and bigger over time as the global economy expands. So I'm not being coy when I say this, but I don't mind this sell-off at all. I really don't. The biggest determinant of future returns is the price that you're paying. If you pay a lower price for the shares, you will have a better future expected return. So if these type of companies in particular sell off to a huge degree, that is a huge opportunity for people that are long-term bullish. You can collect such a huge share count at much cheaper prices. And I plan on taking full advantage if that's the case. So that's the plan. Pretty simple. If you want to see how this turns out, I'll have more updates in the future. Subscribe to the channel and you can follow along for free and see how this turns out. If the train wreck gets worse or if I recover, either way, I'll show it.